Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, December 6th, 2024. Hope everyone's having a great week. As always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what does the November jobs report signal about the health of the U.S. labor market? Our answers are the U.S. labor market is moderating but not falling off a cliff. This is consistent with the soft landing the Fed has been setting and guiding U.S. monetary policy for since last November when we authored our bullish Jay wants a soft landing theme. That theme, coupled with our now 28-month-old resilient U.S. economy theme, contributed to my repeated declarations that this was the most bullish I had ever been in my career last fall. The S&P 500 and Bitcoin have returned a whopping 41% and 183% since then, respectively. Our confidence in our bullish fundamental outlook helped 42 Macro clients maintain confidence in our generally bullish KISS and Dr. Mo risk management overlays throughout. Looking ahead, the positive supply shock from the Biden administration's ultra-lax immigration policies contributed to disinflationary, above-trend economic growth, which contributed to persistently above-trend rates of corporate profits growth. The U.S.'s working age population is simply not growing fast enough to maintain these positive dynamics if the incoming Trump administration's policies have a net negative impact on immigration, however politically popular they may be. Transitioning to our 42 Macro dashboard, as always, we wrap up with a question from our community. This one's regarding NFP revisions and data quality. Says, hi, Skipper. Thank you, as always, for keeping us on the right side of market risk. I have a question. You're welcome. Appreciate you. Says, I have a question regarding the QCW revisions as we head into the first half of 2025, especially in light of the recent NFP print and monthly revisions. Consensus seems to anticipate significant downward revisions for the second half of 2024. Do you think these revisions could potentially trigger a risk-off, a RORO signal around the first quarter of 2025? More importantly, would the market even respond meaningfully to trade around such revisions? Lastly, I'd appreciate your thoughts on the overall quality and robustness of these data sets, particularly given the challenges like lower response rates and other methodological considerations. Looking forward to hearing your insights. So, boy, this is a loaded question, a loaded series of questions. I'll try to keep my responses brief as it is. In fact, Macro Scouting Report Friday, and we have thousands of clients around the world eagerly anticipating our December Macro 2024 webcast this afternoon. So, getting back to the question, so I'll just unpack them in order. Going back, so do you think these upcoming revisions could potentially trigger a RORO phase transition signal around the first quarter of 2025? So the answer to that is no and no for two reasons. One, in the first quarter of 2025, we are still anticipating $700-800 billion of Treasury General Account spend down as a function of the U.S.'s lapsing debt ceiling moratorium and what is likely to be a multi-month impasse in Congress to kind of argue over the shape of what that's going to look, what a debt ceiling increase might look like, and what policies might have to get attached to that. And then secondarily, it's not, I mean, I've been doing this for almost 16 years now. I've yet to see a revision to a data set cause a risk-off market regime. Right now, and if markets are already currently anticipating significant downward revisions, why then would they be surprised enough to transition to a risk-off market regime when the negative revisions are codified by the QCEW time series, which is a very lagging time series? When you're thinking about the jagged edge of economic data, you always have to be cognizant of the trade-off between the speed of delivery and gathering new insights relative to the quality and robustness of the data, which is something the question kind of goes on to anticipate. And with respect to those two things, it is what it is. One of the reasons why we here at 42 Macro and the vast majority of the top institutional asset managers in the world, whether they be macro-oriented or micro-oriented from a bottom-up stocking perspective, we all analyze data in rate of change format. We don't sit on Twitter all day thinking about, okay, well, this data set is, this response rate is that response rate is this. We're not going down these, sort of intellectual rabbit holes, just for the sake of having data arguments and trying to sound smart on Twitter. What we're doing is analyzing the momentum and accelerations and decelerations in the time series on an apples to apples basis to understand whether or not growth, all these different cycles that we care about are either accelerating or decelerating and potentially on the precipice of an inflection from the prior trend. That's what matters. That's the data sets. That's the information that asset markets are looking for when they are interpreting economic information. The market doesn't care about, whether the jobs report was, the 3-month moving average is 138,000, which is what it currently is for private payrolls, or if it's 125,000 or 95,000. The market cares if it's trending lower or trending higher, and if it's about to inflect into a different trend from a directional standpoint. So you have to reorient to your framework if you're going to be paying attention to macroeconomic data away from how accurate is this particular signal, and shift your gears towards what does this new piece of information signal about the rate of change, the trend, and where we are in the broader cycle for this particular indicator, whether it be growth, inflation, policy, profits, or liquidity, and positioning and sentiment as well. So that's how we think about it. That's how most of the world's major Wall Street institutions think about it. So hopefully you guys are taking cues from us, and following them in the footsteps. But obviously, you guys can do whatever you want from that perspective. And then one final thing I'll say is that when you're talking about the challenges of like things like response rates and methodological considerations with data sets, you always have to remember that you can't just focus. You can't. I was having a conversation with one of our friends this week on this particular subject matter. You can't base your economic opinions on one data set or one narrow subset of data sets. You always have to be looking at the preponderance of information in order to create a very robust, defensible view, again, of where we are in those 6 cycles that I just highlighted. So whether it be the jobs report coming from the BLS, or the PC report, which contains very important insights about the health of the labor market in the context of nominal employee compensation, nominal wage and salary income coming from a different government agency, the BEA. We also have the Department of Labor maintains the jobless claims data sets. So these are 3 big, different data sets from different agencies that you can use to formulate a kind of a triangular, you can use to triangulate a very robust defensible view of the labor market without having to, kind of be anchored on, okay, well, the employment survey said, or the household survey said this, or the establishment survey said that. And you're kind of just, again, getting into these time consuming intellectual rabbit holes on Twitter. This is not what the best institutions in the world are doing. We're not doing that in my client meetings. I've probably had, I don't know, upwards of 5,500, institutional client meetings with many of the world's top asset managers across global Wall Street throughout the course of my career. We don't have those conversations that I see on Twitter. We don't talk about the stuff that I'm listening to in these finance podcasts, which I increasingly do less and less of because I'm realizing there's not a tremendous amount of value. I mean, you go back and listen to most of the finance podcasts over the past couple of years, I'd say 85, 90% of them were all bearish in like a back-to-back 20+% up year in the US equity market. Like, I mean, come on. I mean, when's the last time we had back-to-back 20+% up years? Got to go probably to the late 1990s. And so, I think folks are realizing one by one, and I can certainly see it in the dramatic acceleration in the growth of our client base over the past year or so. I think people are starting to realize that free financial information, you get what you pay for. It's free for a reason. And so we appreciate each one of our several thousand clients, and we appreciate anyone who's paying attention to this. That's not a client that is kicking the tires in 42 macro. Hopefully, hopefully you make the decision that's best for you, whether it be subscribing to 42 macro or not. With the end of the day, we don't really care. What we care about is doing right by our clients, whether you join our community or not. We obviously hope you do, but we appreciate you if you don't. So we'll wrap it up there. Everyone have a wonderful weekend. We'll catch you back here on Monday. Cheers.